John Bone. We're going to be looking in financial reporting analysis at a number of different areas, but we start fairly simply with an introduction to the major financial statements. Okay, our first learning outcome up here says describe the roles of financial reporting. And what we've got here is a quotation from the International Accounting Standards Board's conceptual framework. So let's have a look at it together. The objective of the general purpose financial reporting is to provide financial information. I don't think there's any massive shocks there. About the reporting entity that is useful to, and this is the key areas then. So who's it going to be useful to? Existing shareholders. So in other words, it's going to report the performance over the periods. Potential investors, so shareholders that are, or people that are thinking about becoming shareholders. Lenders, people that are thinking about providing the company with finance by the way of loans or maybe buying bonds, and any other creditors in their decision-making role. Okay, so it also says, what's it going to tell us about? It's all about providing resources to the entity. So it's going to give information to both the shareholders and the debt holders of the company when they're making their decisions, whether to buy shares, whether to provide loans, etc. So notice it then finishes up by actually kind of reiterating this. Those decisions involve buying, selling, holding equity and debt instruments, providing or settling loans and other forms of credit. So really, it's got a big focus on people that are providing finance or people that are thinking about providing finance to the company. Okay, so you can see using the information in a company's financial statements along with other information allows us to make the economic decisions. It could be evaluating securities, and of course we can use the accounts as the basis of our financial modelling. Could be that we want to calculate free cash flows, could be that we're looking at dividend streams, could be that we're looking at residual income modelling, but we'll see that financial statement has a big role to play in equity valuation. Could be that we're evaluating a possible takeover, so acquisitions, mergers and acquisitions, of course financial statement is very important, or it could be of course that we're considering making a loan or buying a bond, and as a result we want to establish the creditworthiness of the company. Okay, now of course we want to evaluate the company's past performance, particularly in equity valuation and its current financial position, in order to generate an idea about the firm's ability to earn profits or cash flows in the future. And of course that's the basis of things like price earnings multiples, it's the basis of free cash flow modelling, dividend valuation modelling and the like. So our next LOS asks us to describe the roles of the key financial statements. And we're going to be looking at 5 key financial statements here. Our first financial statement that we're going to talk about is the income statement. Now notice the income statement has some alternative names. It could be called the statement of operations or alternatively the profit and loss statement. Now we tend to define the income statement as a dynamic statement. And the reason we call it a dynamic statement is it spans a period of time. That period of time is between 2 balance sheet dates. So it's going to summarize the events over a period, and it essentially divides the events into 3 major categories: revenues, expenses, and gains and losses. So let's make sure that we know essentially the definitions of each of these items. So notice revenues are inflows from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. So what is it saying? The revenues, if you like, are the sales that we are generating from our core operations. Notice then we've got a definition of an expenses. These are going to be outflows from delivering or producing goods and services that constitute the entity's ongoing major or central operations. So typically our expenses are going to fall into 2 categories: our costs of goods sold, the cost of manufacturing the goods that we intend to sell, and our sales, general and admin, all of the costs involved in selling goods and running the business on a day-to-day basis. Now our final little line talks about other income and mentions gains and losses. So it could, you can see, it may be arising in the ordinary course of business or may not. So it could include, other income could include maybe dividends that you're receiving as a result of holding investments. It could include gains and losses on the disposal of your long-lived assets. It could include gains and losses on the retirement of debt. Okay, our next financial statement is the statement of comprehensive income. Notice it reports all changes in equity except for shareholder transactions. So what do we mean by shareholder transactions? Well, shareholder transactions, we're talking about issues of equity, we're talking about buybacks of equity, and we're talking about dividend distributions to the stockholders. So your statement of comprehensive income essentially is going to take net income from the income statement. It's then going to pick up on all of the other unrealized gains and losses that have been taken directly through to stockholders' equity. And we'll have a good look at it a little later on. You should be a little bit aware that it can be reported as a separate financial statement under both IFRS and US GAAP, but it doesn't need to be. Under IFRS, you can tag it on to the end of your income statement. Under US GAAP, you can include it in the statement of changes in stockholders' equity. Okay, our third primary financial statement is the balance sheet. Now notice we describe this as a static statement. It's the company frozen at a point in time. And what the balance sheet is going to really show us is everything that the company owns or is owed, in other words, assets. It's going to show us everything that the company owes to both third parties and shareholders. Well, the amounts they owe to third parties are going to be liabilities, and the amounts they owe to shareholders are the owner's equity. Now notice we have our balance sheet equation here, assets equal liabilities plus owner's equity. So essentially we can rearrange that and say assets minus liabilities equals stockholders' equity, the key balance sheet equation. This must always hold true, and it's why a balance sheet is called a balance sheet. The mechanism of making sure that assets equal liabilities plus owner's equity, of course, is double entry bookkeeping. So let's have a little look at our definitions here. Assets are resources controlled by the firm, and the basic idea therefore is an asset will lead to a future inflow to the company. Liabilities are amounts owed to lenders and other creditors. Really, these are amounts that are owed to third parties rather than the shareholders. So these are going to lead to future outflows to the company. Owner's equity we describe as the residual interest. Remember what we said, assets minus liabilities equals stockholders' equity. So if we take the assets, subtract the liabilities, anything that we have left over, well, that belongs to our common stockholders. Excuse me. We also have our fourth statement here, which is the cash flow statement. The role of the cash flow statement is to reconcile the cash in last year's balance sheet to the cash in this year's balance sheet. In other words, what it's trying to do is pick up on the changes in cash. So as it's reconciling between two balance sheets, it's another dynamic statement, and as a result spans a period of time between those balance sheets. What it's going to do, it's going to look at our change in cash and split it into three primary areas. The cash flow from operations, or operating cash flows. This is the cash that we've generated from our core activities. Cash flow from investing, which essentially is cash that we spend on buying plant, property and equipment, from disposing of it, and also investments in other companies. And then finally, the last classification that we have are our cash flows from financing. And this is cash essentially spent or raised, issuing and buying back debt, issuing and buying back equity, and it also includes dividends under US GAAP. Okay, so the cash flow statement, really just reconciling the change in cash and splitting it into those three cash classifications. We then have our statement of changes in owner's equity. Again, it's going to be another reconciliation. What it's going to do is it's going to take stockholders' equity in last year's balance sheet and reconcile it with stockholders' equity in this year's balance sheet. So it's going to pick up essentially on any new issues of shares. It's going to pick up on buybacks of shares. It's going to have the net income coming in from the income statement. It's going to have any dividends paid out. And then it's going to have what we call other comprehensive income items. And we're going to talk about those a little bit later. These are essentially unrealized gains and losses that have been taken directly to our stockholders' equity. Our next LOS asks us to describe the importance of footnotes and supplementary schedules. Okay, so these are really going to back up and give us more information on our primary financial statements. In particular, some of the first footnotes that we see set out the basis of presentation, and they set out the accounting principles and assumptions used. So in other words, all the way through when we go through our financial reporting analysis, we're going to see companies have a lot of choices in the accounting policies that they apply. And within those choices, they need to make various assumptions in order to record the figures in the balance sheet, income statement, etc. So therefore, it's very important that the analyst knows exactly what accounting principles have been applied in producing those accounts, especially if you want to compare between two companies, because you're going to need to make sure you're comparing like with like. Okay, our third bullet point says further information on amounts in the primary statements. What you tend to find is the accounting standards boards set out the minimum amount of disclosure that needs to be shown on the primary statements. So the minimum that you have to show on the face of the income statement, the cash flow statement, the balance sheet, etc. You then tend to find that there is more detailed disclosure of those amounts in the footnotes. So we'll find more information on things like pension liabilities, more information on amounts owed from our customers, etc. Also, you'll see data on business acquisitions and disposals, contingencies. Now, what is a contingency? A contingency is essentially a liability that is dependent on a future event. Legal proceedings that we've got directly under contingencies are a classic example. Do you have a liability? Well, you don't know if you've got legal proceedings. You may win the case and not have a liability. You may lose the case and have a liability. So a contingency is really therefore a liability dependent on a future event. You'll see more information on stock options and benefit plans, so we can see the remunerations of key employees. There's data disclosed on significant customers, so we can assess whether we're over-reliant on a particular customer. You'll see segmental data disclosed. Now, of course, segmental data is going to be very important. If you're looking at a company that's a conglomerate, i.e. contains many different operating activities, then the problem with your primary financial statements, the balance sheet, the income statement, the cash flow statement, is they're consolidated. In other words, it includes every division's results mixed together. And as a result, it's very difficult, if you're going to compute ratios, to find meaningful benchmarks. Luckily, however, we have the segmental data that actually breaks down key information like sales, operating profits, assets, etc. on a divisional basis, making it much easier to find benchmarks for our ratios, and also, of course, allowing the analyst to work out which divisions are the key performers within the group. You might see a bit of quarterly data as well reported. Remember, if you're a US company, you need to report financial information on a quarterly basis. Remember, if you're European, typically it's a semi-annual basis. The other thing we've got in here is related party transactions. These are transactions between the firm and key employees and shareholders. What, of course, we want to make sure is those shareholders are protected and the assets are not being transferred to people below their fair value. In other words, we want to make sure all transactions between the firm and insiders are at proper arm's length commercial terms, and as a result, any transaction needs to be disclosed. We also need to describe the importance of management discussion and analysis. Now, this is essentially the information that you find before you hit the primary financial statements. So it's written by the board, the directors and key management. One thing to point out here is that it is not audited. So the auditors do not check the numbers in here. They do read through this area of the accounts, and if it directly contradicts with their audit findings, they will essentially raise it as an issue. But generally, they're not checking each number here. So what is the management discussion and analysis about? Well, really, it's going to be a description of how the firm and its divisions have performed in the past and how they're likely to perform in the future. So it's going to describe the nature of the firm's business operations, and it will break it down on a divisional basis, explaining exactly what each division is doing. And then key, of course, it's going to discuss exactly how those divisions performed over the period. So it's going to give you information on the results from each operation and an overview of how the business performed in the last period. So it'll give you information in trends in sales and expenses, not just in the past, but likely trends going forward. There's also discussion on capital resources and liquidity, so things like the availability of debt, the availability of equity, repayments of debt, etc. Major cash flow trends, discussion of critical accounting choices. Okay, so here again, if the company is to change its accounting principles, not only will you see that change discussed in the footnotes to the accounts, but you'll also see a discussion of it in the management discussion and analysis, explaining exactly why they've changed their accounting policies and why they believe it reflects the true economic position of the company. Okay, so notice as well then, effects of inflation, price changes and uncertainty on future results are also discussed. So any area of uncertainty or risk is really discussed in the management discussion and analysis. So the key with the management discussion and analysis, it's where the analyst can look to get a view of the firm's strategy and how it's performed relative to that strategy over the period. We do, though, have to remember that it's unaudited, and as a result, there could be an element of spin here. The management of the company are clearly going to want to report these things in the best or most favourable light they possibly can. So if they've had a bad year, they might say they've had a bad year, but they'll then try and say how the company's going to turn around in the future. So do be aware of that. Now let's turn our attention to the audit report. Now, we're asked to describe the objective of an audit report and the types of audit report. Okay, so let's start with our first point. The audit is an independent review of the company's financial statements. In other words, the firm's auditors are not employed by the company's management. The firm's auditors are appointed by the shareholders, normally at the annual general meeting, and they're trying to reduce agency cost. Now, what is agency cost? The fact that the shareholders or stockholders own the company, but the management, of course, run the company on a day-by-day basis, and therefore there's always a danger that the management essentially could be hiding things from the shareholders, etc. So the auditors are there to essentially confirm that the accounts are true and fair and free from material error. So that really takes us to our second bullet point. They're there to provide reasonable assurance. Notice that phrase, reasonable assurance. What we're not saying is absolute certainty. So they're checking for reasonable assurance that the financial statements are free from material errors, whether they are genuine errors, i.e. accidental errors, or whether they're caused by fraud. It's reasonable assurance normally because the audit is performed on a sample basis. They sample transactions and their audit methodology is designed to pick up on material errors. Now, what is a material error? Well, materiality is defined by the auditors themselves, and materiality is deemed to be something that is so significant that it actually affects the opinions of the users of the accounts. Sorry. So let's have a look at our audit opinions. And there are 4 opinions that we need to be aware of for our exam. First of all, an unqualified audit opinion. And this is what firms are hoping for. This is the clean opinion. This is the auditor saying, in our opinion, these accounts are true and fair and apply the correct accounting standards. So if you're a listed company, you need to receive an unqualified audit opinion. What happens if the auditors find errors? Well, of course, the company does have the opportunity to correct its accounts. So you can correct accounts and get an unqualified opinion. Now, what is a qualified audit opinion? So this time, the auditors have found a transaction and they disagree with how it's been accounted for. Now, of course, the company could then correct the accounting and get an unqualified audit opinion, but if they refuse to, then they're going to get a qualified opinion. Sometimes we refer to these as except for opinions. What the auditors are saying is, except for the treatment of this particular transaction, we believe the accounts are true and fair. And then they will go on to detail exactly what they disagree with. More serious than a qualified audit opinion is an adverse opinion. This time the auditors are really saying, we do not believe the accounts are true and fair. In other words, they believe that there are errors or incorrect accounting principles that have been applied that are so pervasive that you cannot rely on these accounts to give you a true and fair view of the company's activities and financial position. Then our final one is a disclaimer of opinion, sometimes referred to as a limitation of scope. This time the auditors are saying they simply weren't able to find the relevant information that they required in order to form an opinion. They can't form an opinion, they couldn't get the data they required to substantiate the figures in the financial statements. Notice under US GAAP as well, but not under IFRS, the audit report also needs to provide an opinion on the company's internal controls, and this is part of Sarbanes-Oxley in the US. What are internal controls? Well, these are the controls operating over the company that are designed to minimize the risk of fraud. So let's have a look at some of the data as well that you see disclosed in an audit report. First thing you tend to see is that the auditors set out that it is the responsibility of the management team to prepare the accounts, not the auditors. Why? Well, again, a lot of stockholders incorrectly believe that the audit firm produces the financial statements. They don't. All they're there to do is report on whether those financial statements look true and fair in their opinion. They also state the independence of the auditors. In other words, they state that they're employed by the stockholders, the shareholders, and not the firm's directors. Okay, they'll also make a statement that they're properly prepared in accordance with the relevant GAAP, which stands for Generally Agreed Accounting Principles. And we're going to see two forms of GAAP as we go through financial reporting analysis. We're going to see US GAAP and International Accounting Standards. International Accounting Standards, sometimes just referred to as IFRS, International Financial Reporting Standards. Whenever you see IAS or IFRS in the syllabus, they can be used interchangeably. Okay, so they're checking that these accounts are prepared in accordance with the proper accounting standards, and they've provided their audit to provide reasonable assurance that these financial statements are free from material misstatement. Remember this reasonable assurance because they're using sampling methodology when they're performing their audit. Okay, and of course the auditors also need to form an opinion on whether the accounting principles and the estimates chosen by the firm are reasonable. In other words, what the auditors have got to assess is whether the accounting policies and estimates chosen by the firm actually reflect the true economic substance of the transactions and the position of the firm. If they don't, then they shouldn't be agreeing that these accounting principles are correct. They shouldn't be agreeing with the estimates. Okay, we're also asked to be a little bit aware of supplementary sources of information. So what other information can we get hold of that will help us, essentially? So we've got quarterly and semi-annual reports. We've mentioned these already. If you're a listed company, if you're listed in the US, the SEC requires you to produce quarterly accounts. And these are just updates of your major financial statements, balance sheet, income statement, cash flow, and footnotes. Of course, if you're operating normally within Europe, then most of the exchange requirements are for semi-annual reporting. Proxy statements, and this is typically more relevant to the US than elsewhere. A proxy statement, well, these are held and filed with the SEC, and proxy statements need to be sent to all of the shareholders before there is a shareholder vote. And the key point is they contain information regarding what the shareholders are voting on. So it could be board elections, management compensation, stock options, removal of auditors, appointment of auditors, removal of directors, etc. So before there's any company vote, it's set out in a proxy statement so the analyst could look at the proxy statement to get a good idea of what corporate resolutions the company is likely to have in the future. Of course, we can look at corporate reports and press releases that are written by the management themselves. And then, of course, finally, economic and industry data, whether it's trade journals, whether it's newspapers like the Financial Times or the Wall Street, or, of course, government agencies themselves as well. Our last little LOS in this particular area asks us to describe the steps in the financial statement analysis framework. And notice we've got 6 steps. So our first step is the purpose and context of analysis. And it really fairly straightforward and self-explanatory, really. What you're really asking yourself here, or setting out, is the questions that your report seeks to answer. You're also going to detail the form of the presentation of your results and also the time frame in which you're expected to produce the results. Step 2 is collecting the data. So you're going to collect the data needed to support your, or needed to form an opinion, if you like. So what could this be? It could be financial statement data, it could be management accounts, it could be surveys of key employees and staff members, i.e. Q&A with key employees. It could be visits to the firm, it could be discussions with key suppliers, key customers, etc. So we're going to collect all of our data. Step 3, we then go on to process our data. So typically we're going to make adjustments to the financial statements and then we're going to compute ratios. Now once we've computed our ratios, of course we then need to move to step 4 and actually analyse the outcomes. In other words, with analysing and interpreting the data, what you're doing is you're looking at the ratios and financial data that you've collected and really using it to answer the questions that you set out in step 1. Point 5 is actually writing up the report, so actually preparing the report. And then finally step 6, very simple, is updating the analysis on a periodic basis. Okay, so let's have a little look at a question here. So regarding the report of independent auditors under US GAAP, the audit report, well, let's have a look. A, is unqualified if the auditors disagree with the firm on the treatment of some items. No, of course that would be a qualified audit report. Must provide an opinion on the firm's internal controls. Well, remember this is true under US GAAP but not under IFRS, but the question specifically says US GAAP, so it looks like B is our answer. Let's just check with C. Does not apply to the footnotes to the financial statements. No, of course the audit report does. It covers the primary financial statements and all of the footnotes. What it doesn't cover, remember, is the management discussion and analysis. So hopefully our answer is B.